Welcome to the January 2023 real estate market update with Catalyst Funding. Just wanted to greet everyone. We'll give everyone about another 30 seconds or so to log on. See, we've got a number of people have already joined us today, and we'll do our introductions and dive into all things real estate market update. Give everybody about 30 more seconds, and then we'll dive in. So. That definitely worked. We hit the 12 o'clock mark, and I saw the numbers double right then during that 30 seconds. So that's always important to do. So with that, with no further ado, we'll dive in. And you're here because you like to tune in and stay up to date with the current real estate investment market. We're here because we love to guide you in that. But with that being said, we always like to offer a disclaimer, and that is that this presentation is for general information only. That no information, documents, or estimations presented here represent any final determination on your investment performance. Basically, we're saying we're not held liable. We're trying to provide some best practices and some great information that can guide you, but ultimately any loss or damage that this causes, it's not on us. We just want to be subject matter experts for you. And speaking of those subject matter experts, I want to introduce you to our founder and CEO of Catalyst Funding, Wade Comeaux.
Hello, everybody.
We also have today our Houston Sales Director, Ernest Powell.
Hello.
And we're excited to have a special guest with us today with SecurityNational Mortgage Company, Steve Curtis.
Thanks for having me.
So before we dive into the national and Texas leading indicators, all the recent numbers for San Antonio, Houston, Dallas, Austin, and then everything else that we want to talk about today, I'm going to turn it over to Wade to introduce our special guest.
Yeah, Steven's been a long-term friend of mine for, I think it's almost 20 years now. And we also are super excited that he has joined the group with us at SecurityNational Mortgage Company. Steve's bringing a very large team. I think it's 53 people that joined with him, and they're making a huge impact on the SecurityNational group as a whole. And there's also a lot of exciting things coming up in the future. We're going to be partnering far more significantly with Steven and his group in the future months. At the moment, they're just making sure that they're taking excellent care of their clients, making sure their team's well integrated, and that's a lot to do for a team of that size. But Steven and his team have done an excellent job, but very exciting about the future partnerships and ways we're going to be able to work together. I'll turn it over to Steve for a moment to talk a little bit about what him and his team specialize in and how they can help a lot of people on the call today.
Thank you, Wade. So as he mentioned before, my name is Steve Curtis with SecurityNational Mortgage. We have a team here in Houston of, I think it's 55 now. We've added a couple people in the midst of integrating. It's been a smooth integration for us. We were able to close our first loan within 9 days of onboarding. So that's a testament to our team as well as SecurityNational's willingness to work with us as we come on. So we have 55 people. As I said, we have 4 locations across Houston. Last year we did just over $380 million in total loan origination, mostly focused on primary residence. So we are bringing a level of excellence and understanding and professionalism to the owner-occupied market to partner with Catalyst and create some real synergy, because what we are not very strong at is the investment platform, and they are the best in the entire city and other markets, and we have been #1 in Galveston County for loan originations for primary residents for the last 3 years. So we think it's a really good marriage of the two groups. We are really excited about the synergy. I can't wait to really roll up our sleeves now that we're getting a little bit more comfortable with SecurityNational. And this is kind of one of those first steps. You know, I'm excited to be here on the call and add whatever insight I can, and I just appreciate the invitation.
Excellent.
Absolutely, and we are so glad to have you today, Steve. I'm going to jump off, but I'll be back later as we'll take some questions at the end. So if you have any questions throughout this webinar, feel free to go down to the question part of the control panel, enter those in, and when I come back at the end of the call, we'll have a little Q&A session, as well as one lucky listener will receive half off their next hard money processing fee with Catalyst Funding. You have to be on the call to win, so one of the individuals on the call today we'll notify who has won at the end of this. With that, I'll turn it over to you.
Excellent. And before we move on, I think most of you that listen to the call know me, but I do want to talk a little bit about Ernest. Ernest was recently promoted to our Houston area sales manager. He's been kicking butt for a couple months now. And Jeff is normally on the call today. I'm not sure if Jeff has started to plan his vacations around the monthly webinar, but he has missed 2 in a row. He doesn't take many vacations, but he is taking one at the moment. But we're looking forward to having him back. But Ernest did a fantastic job last month, and I'm sure he's going to crush it again today. So Ernest, if you don't mind, tell everybody a little bit about the Catalyst value proposition.
Absolutely. Catalyst value proposition, we're really excited about it. We do a one-stop shop for all hard money and permanent financing loans. I just actually listened to a call, one of our customers, and we were talking about our one-stop shop, and the customer like, that's what I need. That's the best thing ever, because you're dealing with one person through the entire process. So really proud about that. We're built by real estate investors. So the bulk of our employees have done some investment on their own. They understand the business inside out. So getting that inside knowledge as well has been a help to the process. We've done several thousand transactions. So they're going back to our single point of contact for all your loans. Like I said, we'll do the hard money for you. We'll do the conventional, and we'll also do the non-QM. So you're talking one person, turn in docs, one person, one credit pool. It makes the process extremely easy. Our 5-star customer experience. If you check on Facebook or Google, a different platform, you'll see we're 5 stars across the board. We're very proud about that. Those are real customers. You can see their testimonies they talk about in there. We really value our customer response, so we try to take pride about that. We offer them, say, hard money, conventional, non-conventional, 30-year fixed, no income docs, and landlord loans. So anything in that 1 to 4 unit residential, we can cover it for you for the most part. So any questions you have about that, we can definitely help you. The primary refinance, purchase, and cash out, we can handle that for you as well. And then as we're getting that synergy going with Steve's team, you'll be able to see more products available as well with that. Our hard money loans are really good, and you have our VIP flip program as well. The non-QM loans with FICO scores as low as 620, those are hard to find right now. The non-QM market is changing a lot. So to find a product that will still let you in the 620 is very hard to find. We have one for you, and we have different levels or tiers you can go with that. So definitely give us a call if you have questions in regards to the non-QM market. And then our short-term rental loans with no income docs and no debt. Service ratio for 30-year fix. So any question you have, give us a call. We'll be happy to kind of dig into those propositions with you and go further.
Absolutely. Last thing I'll mention there is that we are expanding our product mix into some new categories beyond just single family 1 to 4. We're moving into the small multifamily now. So if you are out in the market, we can do both interim financing, hard money to fix and repair, as well as the takeout loans in that category. So if you're in that small multifamily space, definitely reach out to us today. And in future monthly webinars, and if you follow us on social or you get on our email distribution list, you'll hear about some other exciting products that we'll be rolling out in the next few months. So we're really excited about that going into 2023. So we're going to be covering a lot of information today, and I want to give a little high-level understanding of what we want to accomplish. And one of the most important things I think in real estate right now is that the market is in a state of flux. It's shifting. We all know that. And I think it's important to understand that the market does not move in unison across the country. So we're going to talk a lot about Texas and the major metros within Texas, and a lot of important reasons that whenever you hear national news about the real estate market, it's important to not become overly fixated on national trends. It's important to understand the market that you're either wanting to purchase a home to live in or that you're wanting to invest in. And it's very fragmented and very unique and very different. We're going to talk about a lot of things impacting the local markets, the markets where you're either investing or buying in if you're a Texas investor. We'll talk about other markets as well. We have a lot of people who attend in other parts of the country, but they may also be investing in Texas because it's one of the best markets to invest in the entire country as well. So one of the big trends out there are migration trends. So whenever you think about things that are impacting the market right now, there's higher interest rates. We all know that. That affects purchasing power, which we'll talk about a little bit later on. But there's also supply and demand. That's arguably the biggest thing that impacts pricing of homes. And there are a lot of different reasons that demand is going up in Texas, but one of the biggest ones is migration trends, right? If you look on this chart, the number of people moving into Texas You know, it's a very significant number. And they're also moving from markets where people are coming with a lot of equity in their homes because home prices are higher, and they're used to paying enormous prices for homes. We're going to go over the affordability index at the end of the call, and that is a big reason why we still see a lot of upward pressure on home prices, and we really haven't seen a huge degradation here yet. So that's one thing we want to start with, are these migration trends. You know, Stephen, tell me a little bit about what you are hearing on the street and also seeing in some of the other data we may not be covering here.
Yeah, so the transient buyer was the second largest group of buyers that we had during 2020, 2021. And another thing that this report does not show is that there are still a lot of very affluent buyers and high net worth buyers that could not win a deal or contract, that are in very high monthly leases. So they are going to be coming into the purchase market as well. Now, luckily, we have more inventory, but that's going to probably stave off, as we always have been last to have degradation to price. That's going to stave it off even more, I believe, because we have very well qualified buyers that were stuck in leases because they were in multiple offer situations. And when your job moves you across the country, you have to get settled. So there's a lot of qualified people that are going to be coming out of leases in 2023 and buying homes, and that's going to further delay any degradation we may get.
Yep, great point. Ernest, any
I would
thoughts?
say, piggybacking on what Steve said, is that those high income earners or high profile people who start buying properties is going to make Texas even more attractive still, because you're still seeing the way these trends are going. I think you get other people who are still in these other states who are looking to come on board to Texas as well. So it may make it last longer.
For sure. Next slide, please. So we're going to talk a little bit about residential construction. We're also going to talk about it geographically. This is national data, and you know, housing permits are coming down, and that's logical. I mean, there are a lot of builders right now that have a lot of inventory on the market. They were building to take advantage of what was the hottest market in U.S. real estate ever. And they're pulling that back a little bit. But one of the things I want to talk about is that sometimes it's very easy to get fixated on year-over-year numbers. But whenever you compare to a more normal market, where we're going on permits now is not outside of a normal market. It's still above what a normal market would be. And we've started to see a little bit of uptick in certain markets across Texas on permits, but overall permits are down. That's something that you hear quite a bit in the market, but I think you really have to look at a normalized market and not just coming off the hottest market that we've had. You know, Stephen, what are you hearing? I know you work with a lot of builders out there. What is the word on the street, especially in the greater Houston and other Texas markets?
What I'm hearing is a lot of people are kind of waiting to see. Obviously, we had the Fed meeting yesterday. We feel like that was good news for mortgage-backed securities. We're going to have probably a very good inflation report in June once we get the May numbers. So I think a lot of them are trying to balance, how do I take advantage of rates that are going to be coming down, as well as material costs that are at the lowest point in the last 2 years. So they're really trying to figure out, how do I plan my starts around having enough inventory ready for when the rates are down, and also not getting too far ahead of myself to where I've just got an absorbent amount of debt. So they're struggling a little bit, but I still think that you're going to see steady housing starts. I just don't think you're going to see the number we saw in 2021, because we're not chasing an enormous housing market like you mentioned.
Yep. All right. We haven't covered this particular report in the past, and I'll point out a couple things I see, and I'll turn it over to the other guys. But I think this is, you know, some important information. So you are seeing, and especially if you're a real estate investor, I think this is important information. So single family permits are down, but multifamily are up. So I think if you're looking at being an investor, that's some very exciting information, because the multifamily investors are very savvy. They have access to tremendous amounts of capital, and they are seeing the ability to be very aggressive in growth right now, because I think the rental market is going to be very strong for the foreseeable future. And as Steve mentioned earlier, you know, once rates start to normalize, people who are on the cusp of being able to buy, but they're struggling a little bit with their purchasing power, that's going to start to move in a little bit later phase. But people have to have a place to live, and they're moving into our market. And so if you look, even break down the numbers a little bit further that we included here for Texas, and you can see Houston in particular is down only 6%, which in the state of Texas is the lowest number to be down. You know, Dallas is down 11%. I was surprised to see San Antonio down as much as was 26. It's kind of a shocking number. And then you go over to the multifamily and how much up. Look at Houston year over year, up 89% on multifamily applications. That's a huge number. You know, but San Antonio strong, Dallas and Austin actually being down. So it definitely, this kind of speaks to the geography that we're talking about and how you really have to look at the market in which you're wanting to buy a home or invest in. So did any of these numbers surprise you guys, Stephen or Ernest?
Not at all. The single family numbers, I think for Houston, 6% seems low for what we're seeing. I think multifamily is right on. We've had conversations before. I think that build to rent is going to continue to be popular. And I think that if people find solutions for that, I think it's going to be something that I think dominates starts for maybe the next 18 to 24 months, if not longer.
Same thing here. Look at this chart, and that 89% jumped off the chart to me. So it made me think from an investor standpoint, how does that impact me? So I was thinking from a landlord, that's good, because that makes me think that there's a market for landlords to continue on and be able to rent properties out. So I want to make sure that I'm going to be able to compete in that market as well.
Yeah, I think those are two great points. There are going to be a tremendous amount of homes coming on the market. Actually, I was listening to a podcast. I'm going to quote a few numbers that I heard that we are at a 40-year high on multifamily permits at the moment nationally, and that there are 1 million new projects that are going to come on the market nationally. So I think in the upper price points, you might start to see a little bit of downward price pressure on these like A-type multifamily properties. That's going to be very interesting to keep an eye on. But in the spaces that we often operate in the single family 1 to 4 space or the small multifamily, I think that's a bit of a different market. And really those new multifamily properties are not going to be competing in that space. There are a lot of people that always have a desire to have a yard and other amenities that come across whenever you're only living in a neighborhood, right? You're not going to have that, especially after COVID. A lot of people saw that they want to have more space, maybe an extra bedroom to work from home. So that's another thing to keep in mind. So whenever Steve mentioned the build to rent, that kind of triggered something in my mind too, because there's still a desire for a lot of people to have that yard, but they may not be capable of buying a property. So I still think that single family rental market is strong.
Wade, one thing to mention, 40 years ago, if you think about that statistic, we're coming out of the Carter administration where we have a high inflation number. So if you're an investor that's going to be in this for 2 or 3 more cycles, inflation just means look at multifamily, because inflation means cost of living is high. People are looking at alternative ways to have a place to live, and multifamily is always going to be a solution for that. So it's no surprise to me that those permits were high at that time, because we had at that time all-time high inflation coming in to a new administration, and then that tailed off. But now that we have highest inflation in 40 years, we also have highest multifamily starts. So I think those two are going to continue to correlate. And if you're in this for another 15, 20 years, next time you see high inflation, you got to jump all over multifamily.
That's a great point. Next slide, please. So this is breaking a little bit on the housing starts and completions. One thing we're starting to see now is that the starts are down slightly, right? But the housing completions are a little bit up. That's logical, because the completions are going to be a lagging indicator. Starts are going to be a leading indicator. So overall, and this is more Texas-based data, but we are seeing that the single-family completions in December were below the November rate. So there's a wide variety of information here, but the most important thing that we're seeing is that at the end of the day, the permits are going to be a little bit lighter in the single family space and up in the multifamily. So it's just another slide to indicate that. I don't know if you guys have anything to add on this particular slide or go on to the next one. Stephen, I'll let you start off on this particular slide. Some real good data here. I've been talking too much, so why don't you take it for a moment?
Well, we've talked about starts, and when I talk to builders, they're having that same internal struggle. when you look at, we're all playing the same game. So whether you're a real estate investor or a builder, that you can only control one thing. The builders control what they can build the home for. As an investor, you can control what you can buy the home for. So everybody's trying to make sure they're positioned the best possible. So in this time when they're trying to figure that out, starts go down. They know that they can get materials cheap, but do they know what they'll be able to sell it for? They don't, and they don't know where rates will be either. So it's going to slow down a little bit, but all of it is inventory. And inventory is helpful to a healthy housing market. But if people can't afford that inventory, they're looking at alternatives, and that's where multifamily comes in. And I think that's why you see those starts at such a higher rate than single family. We've built a lot of homes over the last 2 years, and we still didn't really build enough. But with all the uncertainty, they're going to pause whenever you could push forward in multifamily. That's just where we are. So they're obviously initiating fewer building projects. In our local county, they are approved for the year, I think 23% less starts this year than last year. So it's right on trend with what this shows. So we're seeing it locally too. This might be, this says Texas research. So across the state, even locally, we're seeing it pretty much right on. So there's no surprise here, but we still believe that even if rates stayed the way they are, appreciation would still be 1 or 2% over the year. So home prices are not going down, which means affordability is going to continue to be a challenge that you can solve with those starts with multifamily.
One thing I was going to mention, that this last bullet point here, mentioning that compared with a 5-year average of 94,800 units before the pandemic, this November housing inventory level is only 4.5% away from rebounding back to the pre-pandemic volume, rather than 50% a year ago. So I think that's a very interesting trend, right? So there are a lot of people that are stressed out, like how is the market going to maintain when there's so limited inventory? But there was just so much demand before that it was just overwhelming, and the inventory was super low, but we're almost back to the normalized number of inventory. So I think that's an exciting thing for where we're going in the market. We needed to have more days on market. It was unsustainable, right? It was causing too many multiple offer situations, too many over offer or over ask offers. And so I think this normalization is really just healthy.
Yeah, we got to a point at one point where the greater Houston area was at 10 days of inventory. That's not sustainable. No. You just can't do that. So we're getting very close, and we see it on the single family side. We see it. There's more when the sales cycle used to be anywhere from 1 to 5 months because they can't win a deal, to where now someone might apply on a Thursday and they're in contract by Monday. And that was something that only happened pre-2020, and we're returning to that.
Excellent. Let's check out this next slide. So just a little bit of background on this. This is residential home sales, seasonally adjusted. That's one thing we have to keep in mind. There are some people who are very concerned about some of the numbers over December, January. Some of the national pundits might give some very concerned feedback, but we're really getting back to a market where there is seasonality. What happened during COVID was completely outside of the norm. There was always a little bit of a reduction in home prices going through the winter months, just because there's not as much demand, longer days on market, things that are just common. And so this seasonally adjusted short does help take some of that noise out. But one of the important things that I think are a very good trend is if you look at the annualized rate of sales and how the Texas trend, which is in red, has just been outrunning the national trends since this started in 2000. It has a lot to do with migration, but it's also just has a lot to show how healthy the market is here. And then on the price, Texas started out a little bit lower, but if you notice that price gap back during the run up to the financial crisis was the only time whenever the national numbers were growing significantly greater than Texas. Other than that, it's been somewhat normalized. My guess is one of the things that might have had something to do with that was the A6 limitation of 80% in Texas, where other states didn't have that. Probably some other factors, but that was really a positive for Texas because we didn't have as much to come down whenever that happened. Any other thoughts on this slide, gentlemen? Okay. This single family permits, Ernest, I don't know if you had any particular thoughts on this particular slide.
No, we covered the permits a lot in the last 2 slides. I didn't have anything additional on this one in particular.
Okay. If you do look at the numbers, one of the important things that I just saw here is that this number's kind of covering January through November, and then these are like a stacking up of permits, right? But the new for December actually looks to be a pretty solid trend for the state of Texas relative to the months prior. So a little bit of growth there. All right, so this economic forecast, I'm gonna let Steve talk a little bit about this one, because on the next slide, if we don't mind going to that, this is talking about the purchasing power impacted by rates. So Stephen, I'm interested in your feeling on where rates are going a little bit after the Fed announcement, and then also how buyers are adjusting to the purchasing power. I know there's some unique things that you and your team are doing on areas of buy downs and other things like that to try and take advantage of the situation we're in and where rates are at.
Sure. So I will start with, any year that rates double is going to cause a shockwave through the single family specific buyer, which is why we've had a little bit of a slowdown. Now, we've had some old tools that we're using to solve some new problems. One of those is temporary buy downs. And the reason we like the temporary buy down right now is with all the indicators that I'll get into a second with rates, we know rates are going to come back to us over the next 18 months. So permanent buy downs, which is what you're probably accustomed to hearing, is where you pay a large sum of money to permanently reduce your interest rate. If you were to refinance that loan in 12 months, you never recoup those gains. With the temporary buy down, you're essentially subsidizing that payment, and we're using seller concessions to do it a lot of times. But you're subsidizing that payment to where instead of a 7%, you're paying at a 5% rate for year one. And if you happen to refinance, anything that isn't used in that subsidy pool is returned as a principal reduction. So there's no loss of funds. So it's a pretty cool trick that we've been using. We still have to qualify them on the big number. So it's nothing like, it's not a challenging product for performance or anything like that. They still have to qualify at 7% or whatever that rate is. But we're using it a lot right now because we know rates will return to us. So it's just kind of solving that initial problem. And as the market is balanced, they've been able to get the sellers to help subsidize that as well. Where I think rates will go, I think yesterday's Fed meeting was exactly what we thought was going to happen. We all anticipated they would do a quarter and then say that they would do another quarter. Now, Powell coming out and actually acknowledging that inflation is cooling was unexpected. And that was probably the biggest monumental piece of news that came out of that meeting, is him actually doing something other than having a very hawkish view on where we were. So that, based on that, plus the fact that we know that the inflation numbers that come out on the CPI report in June are going to be in our favor, I think the market reacted accordingly, and we actually broke through a ceiling in mortgage-backed securities that we had tested 9 times before and bounced off of. We broke through it yesterday, and we've maintained above it today, which is great, because if we can stay above that, the run rate to the next ceiling is another 90 basis points, which could bring rates, at least for now, back into the high fives for your single-family residence primary purchase.
Yeah, we're going to cover a slide next that talks about these are some prognostications from January, but I have seen a lot more people talking about rates in the 5s in the second half of the year, which would be great for the market overall. These projections are a little bit higher than that, but this is as of January. One thing I'm pretty sure I saw on a ticker was that I believe he said that he did not anticipate the Fed reducing rates in 2023. Did I see that correctly?
Yeah, so the thing that people need to understand is not reducing them is fine. Not having the pivot is fine, because the space between where the 10-year treasury sits now and where interest rates are is an enormous spread. And the reason for that spread is we don't know when they're going to stop raising rates. So in order to have performance and to create yield, you have to have an enormous spread between the 10-year and mortgage-backed securities. So if mortgage-backed securities are at 6 and the 10 years at 3.5, that's 2.5 point spread. If they stop raising rates for 2 months, what'll happen is we can create yield without having to be 2.5% over the 10 years. So you could actually see rates go to the 5s, still have great yields for investors without them reducing rates at all. So that's all part of the playbook. just stopping the bleeding is step one. They don't have to back off of it for rates to get back in the fives. That's the good news.
Absolutely. You know, this next slide, I want to give a little bit of context here while we're covering this. You know, there are some people that think there's going to be like a big reduction in prices over time. And we've been saying for the entire time we've been doing this webinar that I don't anticipate that in the major markets in Texas. I do think it could happen in certain pockets across the country, and there's probably going to be some degradation in price. And quite frankly, there's a little bit in our local market on a month-over-month basis, not on an annualized basis yet, but and some of that has to do with some seasonality. But I'm not saying there'll be no softness, but the major reduction, we don't really feel like that's going to happen for a few reasons. One, you know, what happened back in 07, 08, 09 was very different because forbearances were treated very differently. Back then, you had to make up, if you hadn't made a payment in 24 months, you had to make up all 24 payments in 1 month, which really is not viable. Now we're talking about tacking on the payments to the end. That's one big difference. Credit quality is exponentially higher than it was back then. The average FICO score is so much better. We don't have these alternative products like negative amortization mortgages and other things that were very difficult. Far fewer arms out there. So for a lot of reasons, we think that we're not going to see as much pressure on prices, downward pressure on prices because of foreclosures and things of that sort. But we did want to slow this slide, which gives a little bit of an update on people in Texas and across the United States, like how many homes are free and clear. You can see that there are more homes in Texas that have that free and clear designation. That's surprising numbers overall. And then also the number of people who are caught up on their payments, still pretty strong. You know, 50, 52, 58, 55, these numbers are far higher than they were in the past. And the people who said they are not caught up on their payments, 4, 6, 4, 4. If you went back and looked at those statistics back whenever you were looking at numbers in the financial crisis, these numbers were 3, 4x of this. So these numbers are still very strong in comparison to that. I know I covered a lot of highlights there, Steve. Are there any other reasons that, I know you and I talk about a lot, any other reasons you think that we're not going to see big drops in these numbers?
Yeah, I think so. A big one is, you know, you and I both worked through the financial crisis of 2008. And a big difference with when you mentioned forbearance is it's really hard for banks to take on the forbearance and do modifications when values are declining. But in 2020 and 2021, when you're having 16, 18, 21% appreciation, if someone had to remodify their loan, it was no problem because they had the equity to do so. So in that way, those modifications were largely absorbed or caught up with no detriment to the financial sector. And in 2008, we didn't have that luxury. So the fact that this was not based on bad lending practices, a pandemic is a once in 100 or 200 year thing. It actually, the increase in home values helped because we were able to absorb the modifications and people were able to come out of forbearance. And, you know, I think at one point we had 13, 14% of people in forbearance. And I think it's in the low single digits now. And most of those are set to come out in the next couple months. So for those reasons, the fact that we're still in an appreciating market, that is the driver. Equity is the driver to everything. And we have more now than we ever have.
All right, so this is a chart on rental vacancy rates, basically a supply and demand chart for the rental market. And there is an uptick on rental vacancy rates, but to kind of speak to what Steven said earlier, if you look at the times whenever vacancy rates have been very low, wasn't times during inflation. If you look at the previous inflationary period, a lot of people had to rent. Rates are too high to buy, right? So tremendous amount of renters in that time. And then I think that's another reason that we're going to see those vacancy rates stay relatively low. I have heard some statistics nationally that there are more vacancies than there were in the previous few months, like this last quarter was not as strong, and that there's a little bit of downward pressure on rent rates, but we have not seen that happen as strongly in Texas and especially in the major metros. Anything to add to that, gentlemen? Okay.
I was going to add the previous slide we're talking about. I meant to say it earlier, but we're talking about the loans and people owning properties and not being past due. So I was working in that servicing side during that time frame too, and short sale of foreclosures. And most of those houses we would look at were underwater or equity. So there's a big difference now. If you were to fall into default, you do have the option to sell your property now and be able to make some money probably still in that process. Whereas back then, I mean, it was hard to get a short seller approved because everybody was so far underwater on those properties, where now you have more options as a consumer to get out of those properties if you had to.
Yep. Great point. Next slide on interest rates. We talk a lot about them. I just like this slide because it brings a little bit of context to the situation. Rates are way higher than they were, 2 years ago. But whenever you look at them in the overall scheme of history, these rates are still incredibly low. These rates go all the way back to the 60s, and people were buying homes this entire time frame and making good housing decisions and benefiting from appreciation if it was their personal residence, or benefiting from appreciation if it was an investment property. So we don't have to deep dive this, but just bring a little context to where we are in rates. And I think we've talked about this quite a bit. For investors in particular, if you can buy a property now and cash flow, if you're at current interest rates, you're going to crush it whenever you're able to refinance in the next 2 years, maybe 3 years, whatever it may, if it's a longer tail. And to talk a little bit about that, I really believe that investors are waiting on the market to turn down. You're going to be waiting too long. You're going to miss the boat. And I actually heard something that backed up some of the data we've been talking about recently. I'll talk about real quick. So we did an evaluation. Our average borrower, before rates went up, was paying about 90% of the after repairs value, less repairs. So give us quick math, $300,000 home, they're paying $270, less repairs. To keep the example simple, I'm going to use 30K repairs on both examples. So $270 less repairs, paying $240. Now we've been looking at the data since rates have gone up, and we've been consistently around 72.5%. So that same property, they're paying about $215 less 30, $185. That's a massive difference. So without the market really coming down, investors are getting exponentially better deals. And I thought that might just be, it's our narrow data set. It's only Houston. But I was listening to a podcast on housing news, and there was a Darren Bloom. You can go and check it out if you want to listen to it, from auction.com. And he said almost the exact same thing. On auction.com, people are offering at a 29% discount, whereas before, transacting at a 29% discount. During COVID, it was a 9% discount. So the numbers are very comparable to ours on a national basis. And it's because, if you're going to be an investor, or if you're thinking about someone buying on the backside, that interest rate pressure is real. But if you're especially buy and hold investors, man, you're never going to be able to get a lower purchase price than you're probably getting right now, and you're able to refinance at a later date. So it's kind of a perfect storm.
And it creates more buying power for the investors. I mean, you think about early in the year, it would cost you almost $25,000, $30,000 to get a property, whereas now you're closer to, and we're seeing deals like 15 to 20. So now that allows you to buy 2 or 3 properties, as opposed to maybe one with the limited capital you may have. So for an investor, this will be the time to get busy.
For sure. I love this slide. I often talk about it, but I'll give the context, and I'll let Steve talk about it a little bit. So this chart basically lays down the total number of housing starts versus U.S. population. And you can see the housing starts just fell off a cliff after the financial crisis, and well below anything even before the 90s. And then we're also going to talk on some future charts about some other statistics there. But Steve, what does this tell you whenever you look at this chart? I think you may be on mute, Steve. Sorry. I can't hear you now. I don't know what may have happened. I'll speak to that a little bit while are you back? Sure can. Can you hear him, Ernest?
No.
Okay.
Am I coming in now?
Bingo.
Okay.
Go ahead.
What I was going to say, and I've had this conversation before, is after the financial crisis, we never really picked back up the same level of momentum. We were never really able to catch up to population. And population is something that's really hard to outrun once you get behind it. So, I think we had the little dip in 2020. I think you see that it starts to pick up in 2022, but we're still grossly under the level that we were at for the previous 20 years.
Yeah, and actually, and I made a mistake here. The next slide we're intending to show, if we can pop there, I was intending to show this slide back to the 50s. I think I must have sent Derek the wrong one. But if you look at the slide all the way back to the 50s, the number of homes built for the decade from like 2010 to 2020 was lower than any other decade, including when the population was half of what it is now, which is pretty amazing. So despite the fact that, building permits may be down a little bit and some different things like that, the supply and demand numbers are still going to be in home property price appreciation's favor in the long run, even despite the fact that the interest rate market is so different than it was a year ago.
Yeah.
All right, Stephen, you're definitely an expert in this Houston market. Why don't you cover this slide for us?
Okay, so year over year for Houston. 2020 was the first year of declining home sales for the Houston market since 2015, with 95,113 single-family homes sold versus 106,756 in 2021, which is a decline of just under 11%. Total volume was only 1.5% to 39.53 billion. So what does that tell you? We had less year-over-year home sales, but we still had a level of appreciation to where the total volume sold was only 1.5% less, even though we sold 11% less homes. So what that says to me is, okay, so we still have a very strong market in Houston with prices. It is softening some, but like Wade said earlier, it's all relative, right? If you had astronomical appreciation during the pandemic, then you're going to be the first one to have astronomical softening. I feel like ours was always below the national average, and I think that's why we're the last to soften. On the single family home sales, what we talk about all the time is, we were in an incredible seller's market. And what you have to understand is when you're in a seller's market where people are paying over, they pay the title policy. I mean, I even saw people paying people's Netflix for a year, all these crazy things just to win a bid. And then you have to go all the way to, I'm getting a discount and you're paying my closing costs for it to be a buyer's market. And we're just not there yet. You have to move all the way through balanced market, which is what I believe we're closest to. We don't have a lot of multiple offer situations anymore on the single family side, but we are seeing, maybe $5,000 off, maybe $5,000 in concessions, but we're not seeing significant reductions. Days on market is the thing that's increasing, but we needed that for the inventory. So right now I feel like we're right kind of in the middle. I think we still have a whole nother tranche to go through before you say this is a buyer's market and we're starting to see prices come down significantly. But just the fact that we had 11% less sales but only 1.5% less volume is a testament to the strength of this market.
Absolutely. Next slide, please. One thing I see here, and you look at these numbers, single family months of inventory 1.4 versus 2.7, that looks like a big increase, but to Steve's point earlier, I think 6 months is a normalized market, right? So we're still well below that normalized market, and really shouldn't compare to a 1.4, which was a historic low, just kind of unprecedented and unsustainable. Any other things, Steve, you or Ernest, see on this slide that jump out?
Well, going back to inventory and also talking about housing starts, if we continue to build at about 85% of population growth, it always looks good on a chart. Oh, it's only 15%. Well, when the population becomes 600 million,
yeah,
now you're 50 million homes short. We're never going to be able to build 50 million homes in a year. So we're going to continue to have inventory in a place that's going to create a nice competitive balanced market in this area. That's just something I would just continue to think about.
For sure. All right, so San Antonio, whenever we're on this call, we always talk about probably the top two major metros for single family 1 to 4 investors are Houston and San Antonio. Lower average home prices, very attractive rent rates. So if you're out in the market considering some great places to invest, we think those two are very, very strong. And you know, we saw those statistics earlier that single family starts in San Antonio were way down. I really don't know exactly why that would be. I know that's still a pretty strong market overall. I know it's kind of tied to Austin in many ways, so maybe that is a big part of the pull down. But you know, you'll see in a later chart the affordability index is still very strong. You know, the pricing here that you're seeing on a year over year basis still up 6%. Average price still up 6% on both median and average. Total sales definitely down. That's not unexpected. And then you have the days on market up pretty significantly, up to 59 days. But if you think about it, that's still a very normal, below normal market. And then the months of inventory 3.2 above Houston, which was at 2.7, but still in really good shape compared to a 6 months of inventory. Then that average residential rental continues to increase there in San Antonio. It's not as high as Houston's average rental, but still continuing to grow. Any other thoughts on that San Antonio market, John?
I know you mentioned that the rental income wasn't as high as Houston, but I believe that the cash out of pocket for rentals in San Antonio market is a lot less than Houston too, so you might get more cash in return in that market.
Yeah, that's one important thing for investors to always remember, and that's one of the best things about the market today. Because interest rates are higher when you first start, you're probably not going to get as much cash flow, but your out of pocket is so much lower that your ROI is fantastic. The ROI is excellent right now. If you can be half out of pocket as you were 6 months ago, 8 months ago, and have comparable cash flow, maybe you're down 100, 200 bucks. That's still excellent return on investment. All right, Austin. You know, I'm going to cover a few highlights here. The median sales price is down. That's the only major metro where you're going to see that statistic. But they had such an incredible run up. There just had to be some place to come down. And I really would not get overly concerned about those numbers in that particular area. I think there is going to be still some growth over time because a lot of people are moving there, but it was just unsustainable and completely out of control. I mean, there was a point where I think the months of inventory there in Austin was like a 0.3, which is, it's hard to even wrap your head around, but now it's up to 2.7. So still very, very good compared to a 6 month stabilized market. Anything else jumping out for you gentlemen here? Cover Dallas for us. Ernest Powell, you may not know this, but he lived in Dallas for a long time, so he's a bit of a subject matter expert.
So Dallas, just kind of looking at the strong word, expert. But yeah, so you see the median price is up 8%. Active listings up 219%, which jumped off to me. And then the months of inventory went from 0.6 in 2021 to now is at 2.1. So it pretty much doubled a little bit in size. So you can see there's a little bit of softening appreciation, but it's after a period of like hyper growth in the last couple of years. It looks like Dallas will remain healthy and stable. Also, I read too that they're bringing I think it's a Disney World to Dallas here soon, which is going to increase everything surrounding Dallas. So that's going to be a major portion to the city as well.
That's exciting. I did notice that the months of inventory is the lowest among the major metros in Texas. So still a pretty relatively warm market there. And then their median sales price year over year is the largest increase that I saw amongst the 4 major metros, with Austin being down slightly. So I think Dallas is still a pretty strong market. It can be a little bit difficult if you're a single family investor. I know some multifamily investors that are crushing it over there right now. The single family investors that are kind of dedicated to stay in that market, we do have quite a few. They're just going a little bit further outside the city and still doing quite well. And that's not uncommon in a lot of markets. If you go to places that a lot of investors may be unwilling to drive 30 minutes outside the city, maybe an hour, there's some smoking deals out there right now. We're seeing some zero out of pocket deals if you're willing to go to tertiary markets. Steve, I'm sure you've seen the affordability index before. We kind of break it down a little bit different, and we kind of compare like the top 5 markets, and we cover some of the we throw quite a bit of Texas in there. What thoughts do you have on the affordability index, and maybe just an overview of what it means in your mind?
I think that when you look at this and you look at Austin, Dallas, and Houston, you know, high population areas that still have extremely low affordability. Share of income being under 42% for Austin is surprising, but it means that that's a very strong market. Houston being at 36 is a huge deal. Fort Worth at 33 and San Antonio at 32. I mean, those are all very surprising numbers when you think about the populace of those areas. Look at other areas that have millions and millions of people. Miami's 85%, Los Angeles at 82%. New York at 78%. And when you look at the migration data, people are leaving New York to go to Florida basically, and Californians are coming to Texas. So when you look at them, they're leaving places that took 85% of their income to live, and they're coming to a place that is 36, you know, which is just, you know, which means that those people could decide that now they can buy an investment home as well. So I think it just continues to add fuel to the fire of our housing market. So I think the starts here will continue to happen. I think they're figuring it out right now, but I think towards the end of this year, you're going to see that tick up. But affordability is a big deal, because if you get consistently above 50%, that's where you start seeing real pressure on, you know, prices. You'll start seeing starts almost stop. You'll see permits almost stop, because you just don't get a normal person that has a regular 9-to-5 cannot buy over 50%. You just can't do it. So they understand this chart. This chart's important to builders, but it also should show you an indication of just how healthy our market is still. December 2022, under 40 is incredible for the amount of people that live in those areas.
Yeah. A couple other thoughts, and we didn't always do this, but we started to put this side by side. It's very interesting. So the chart on the right is a year ago, and you can see there's really a lack of affordability index, but you had Austin, Dallas, and Houston all in a row, 20, 21, and 22. And as we've seen interest rates go up and other factors in the market, Austin went down to 24, Dallas down to 34, Houston down to 43, and San Antonio in the previous year was 60, and it's kind of holding. It's actually degraded a little bit to 54, but overall, these other three major metros are just becoming more attractive in this time, right? It's not the opposite. It is more attractive. So our market is more desirable. And another thing that's not really baked in here, this is just covering housing prices, but you know, many of those other states also have state income tax, which absorbs more of their income. They have even less of their income with which to pay for a home. Higher gas prices and other things are also more expensive. So because of these things and a lot of the other things we talked about, we're still very high on the Texas real estate market, especially in the major metros. And then, you know, one last thing to mention is the amenities, like the Houston, Dallas, Austin amenities are very strong in comparison to these other markets as well. Restaurants, nightlife, things like that. So anyway, I think we've covered a tremendous amount today. Hopefully we have some great questions coming up. Any last thoughts before we dive into the questions, Stephen or Ernest?
I would just say, comparing to the last slide with Dallas and talking about how it's a little bit more complicated to get properties there, looking at this list, I mean, from 47 to all these other cities that are surrounding Dallas, so that Irvin, Fort Worth, Arlington, Garland, so in Plano, all those areas are right on the outskirts of that DFW area. So people are willing to go on the outsides and still be close to the major metro because it's more affordable.
Yep.
Yeah, the only other thing I would say is, you know, just going back to, you know, the time is always now. You know, there's always windows and opportunities in every market. I really think as an investor, this is your time to get deep buys. You also don't have the institutional investors returning yet. So I think you've got a little bit more time that you can really get in and get some really good deals. So I would get aggressive and I would get creative, because right now I think there's deals to be had. And I think when interest rates get back to 5 something, you got a little bit more competition. So I think if you can go after the deals right now, I think long term, especially if you're someone that's wanting to hold, this is where you're going to make a lot of money. Maybe not today, but at 12 months from now, you're going to really like your position.
Yeah, I would add to that that I think our borrowing base at the moment seems to be a little bit more the experienced, savvy investors that have been around a little bit longer. They've seen these up and down trends. They've bought homes in higher interest rate markets, We're really trying to encourage some of our newer investors, like, don't miss out. Don't only buy when everyone else is buying. That's very comparable to saying, the stock market's going up. It's at an all-time high, so I want to buy now. Warren Buffett always said the time to buy is when there's blood on the streets. That's a little bit of a brutal reference, but still, it does make sense. You can't only buy when things are at the top. You want to buy whenever there are challenges, and that's whenever real opportunities are presented. So I think both of your points about this being a great time are on point. I don't know. I know Derek's in a bit of a snowstorm up there, so I'm not sure if he is available to bring our questions in. If not, maybe there's a different way to get them to us. But Derek, are you available to discuss the questions?
Yes, absolutely. I'll jump back on
there he
and
is.
do our questions, and then I'll announce who the winner is for the drawing today. So
Awesome.
the first question we have is related to, I think it came during the time Ernest was talking about some of the different low buy options that it's related to equity. They said, is there any more information you can give providing related to instant equity in those type of purchases?
Well, Ernest, I don't know if you have a thought on that. I might if you don't.
I don't. Let me hear your thoughts so I can add on to it.
Sure, no worries. So I think we were talking about potentially talking about the data that came from auction.com, saying that there were on average a 29% discount versus a 9% discount before rates went up, and seeing those same trends in our market. Ernest is deeply involved in transactions every day, and he's one of the first people to bring this up. So we went and did the data, and people offering 72.5% of after repairs value instead of 90. So as far as the I don't have any more data than that. If you wanted to check out that particular podcast to get the national trend, I can mention it again. It was the Housing News podcast presented by Housing Wire, and the guest was Darren Bloomquist. So, and I think it was maybe a day or two ago that came out. As far as internal data, we've had a relatively consistent trend of being in that 72.5% of after repairs, maybe going up a 1 or 2%, maybe down 1 or 2%, but the average has been that. So definitely seeing very deep buys for investors at the moment.
And also adding on to it, so it's not as competitive as it was, top of the year. So top of the year, people were paying over and beyond the asking price for properties, and even on the investment side. So where when the rates increase, I don't want to say it scared away, but it weeded out some of the new investors. And so the more experienced guys were still doing deals and now able to get those deeper discounts that typically used to see pretty much.
Absolutely.
Okay, question number 2. So it's from a person that says, what is better, to cash out refi or refi and wrap equity into the refinance?
I'm not sure exactly. Steve, do you know what that?
I'm struggling to understand if they're asking just to get the cash or if they're saying cash specific to buying property. The vehicle's the same. It's just what you do with that equity once you tap it. If you're discussing your permanent property that you live in. So I think they may be saying the same thing, but the way that the vehicle is the same, the way you execute is up to you. The cash is just given to you directly, and then you would allocate that to investments, whether it be real estate or flips or however you see fit. I hope I'm answering that correctly. If not, Derek, if they have a follow-up, I'm happy to answer it.
Absolutely. If you have a follow-up question, feel free to write back in.
If you don't mind, I might give another thought. I think it may potentially also be like, should I just straight refi, or should I refi, take cash out, or what should I do with the cash out? I would say this: there's 2 schools of thought out there with what you do with debt, right? There's the Dave Ramsey thought, all debt is bad debt. And then there's the Robert Kiyosaki, Rich Dad Poor Dad, that debt and leverage are the way to increase wealth. I definitely believe in the Robert Kiyosaki philosophy. So if you're taking equity out from your home, you have a choice. I could do something more fun with it, do a kitchen remodel. I can build a pool. I can maybe remodel the house entirely, take a trip. There are a wide variety of things, right? And those things have a place. I'm not trying to say that they do not. But I think in a large part, if you're going to take out debt, it should be used to increase wealth and to buy assets. So if that is the question, then I would definitely say we can, if any of you have questions on this, we have a powerful presentation and spreadsheet that any of our loan officers could go over with you to show you, even if you only have 50,000 in equity in your home, or if you have 100 or 200, we can show you very specifically where your net worth will be 15, 20 years down the road. So if you want to see that exercise, please give us a call and we can walk you through it.
Excellent. And then to let everyone know, we do have a drawing each time where one lucky listener receives half off their next hard money processing fee with Catalyst Funding. Today's winner is Wesley Bryant.
Congratulations, Wesley.
So Wesley will be in touch with you about details about that. And anything else before we sign off today? Wade, I'll give the mic to you.
The only thing I want to say is that our team has always been solid, strong on owner-occupied loans, but with Stephen and his group coming on board, we're talking about an entirely different level of expertise. That's what they focus on every single day. Absolutely fantastic at it. So if anybody on the call is looking at buying a property or thinking about doing any type of second home purchase or anything like that, definitely reach out to us. Him and his group will put you into the absolute right product. So let us know if that's something that's of interest to you.
Thank you, Wade.
All right. Thanks, everybody. You have a great day.
Thanks, everyone, for being a part of the market update. We'll be back next month. And again, thank you, Steve, for being a part as our special guest today. And as always, to Wade, our founder and CEO, and Ernest, thank you for providing the input today as well. We'll see everybody next month on the real estate market update. Take care.
Thanks.